There is a famous saying, money saved is money earned. Why I am saying this? Because bear market has already entered in US stock market on S&P 500. We have given a sufficient time to discuss about the US bear market. But we are more interested in Indian stock market. So in this video, I'm asking a very pertinent question. Should we remain invested in bear market? There are always two viewpoints to it. I'm not going to contest whether viewpoint X is good or viewpoint Y is good, because our sole aim is to position ourselves into the stock market so that we can maximize our profit. Am I right in saying so, friends? Do write a comment in the comment section of this video. One school of thought is that secular trend always remains bullish. So we should not exit in the bear market. And this is the viewpoint of many successful investors all over the world. I'm not questioning their ability to analyze the market, because they work on a very simple principle that fundamentally sound business, although may drop, but such stocks are the bouncing balls. Ultimately, when the bear market would be over, they will bounce back eventually. They believe that it's very difficult to time the market. I here little bit differ. So what I will do, I will discuss each and every bear market that has occurred in Indian stock market and see the possibility whether we could have timed the market to re-enter and exit the moment. After we have exited, the moment market is entered into the bear market. Now, can technical analysis help in to time the market? The question arises here. Today, we are in a position to set alert on the price chart, anticipating the possible move and reversal chart pattern. So when market enters into the bear market, means it breaks down by more than 20% from the recent peak. That is the time to exit from the portfolio, because nobody on planet Earth can say what would be the extent of drawdown. This question becomes very important, especially at the time when US market is already into bear phase. S&P 500 is already corrected more than 20%, to be very precise, something around 22% or so. And NASDAQ 100 has corrected more than 30%. However, Indian stock market has not entered into the bear phase, but there has been sizable correction to an extent of 18%. So that threshold in Indian stock market is not far off, where Indian stock market may also be defined to be in the bear phase. So let us prepare ourselves for the bear market investing and find out the questions based on the bear market history of Indian stock market, especially Nifty 50, which is broadly followed index from India, as to whether was it possible in each bear market to time the market and still protect ourselves from a major drawdown which might happen in the stock market, and re-enter the market at a suitable time when trend reversal takes place. Thus, we can save the money and enter the market much better valuation. So let us discuss this very important topic. And friends, like this video right now, subscribe the channel, hit the notification bell so that you remain updated all the time. Everything has to be understood with a very important aspect of the stock market. Our capital infused in the stock market is our oxygen, and a major drawdown in that capital will make it more difficult to recover the loss that we incur in the stock market. Because if the stock market, like in 1929, drawdown has been more than 80%, which means if you have invested 100 rupees in the market, if a drawdown extends to 80%, your capital will erode by 80% and will remain at 20 rupees. Now, in order to recover and reach to the level of 100, your capital has to rise 80 rupees, which means what? 4 times from 20 rupees. And that makes it so difficult to recover even the base capital. Because nobody on planet Earth can ever say the extent of drawdown in the bear market. Since existence of Nifty 50, India has witnessed 5 bear markets. I am not considering the present 2022 downtrending market as a bear market because it has not broken down below the 20% threshold from the recent peak, which it has made in October 2021. So the first bear market was in 1992, which has a drawdown of around 53%. Then again in year 2000, drawdown was 53%. Then we know the financial crisis of 2008, drawdown extended to 64.56%. Then March 2015, which is the least discussed bear market because it has a very shorter life. Although drawdown has been 25.15%. In January 20, very recent bear market we have seen extended its drawdown to 39.6%, and currently we are having a major downtrending move in Nifty 50. However, we do not know the bottom, so we do not know even the possible drawdown or even the market will go into the bear phase or not. So now let us discuss each bear market on the price chart and see whether there was a possibility to exit from the market. The market entered into the bear phase and thus save the money to allow the principle of money saved is money earned, and then re-enter the market at a better valuation. So let us check it out on the price chart. Now we are starting with the bear market of 1992 that started in April 1992. We can see the market made a peak here. In fact, the Nifty 50 had an inception in July 90. So it started, came in existence in 1990 only. And there was a substantial rise in the market. And then the market from 1280.9, the peak it has made in the month of April 1992. And there was a sizable drawdown and it made a low of 599.5 with a drawdown of 53.2%. And this bear market lasted for nearly 1 year, that is 12 months. Now let us see whether we could have timed the market if we had exited the market. Post market has broken down by more than 20%. So friends, in bear market April 1992, there was a drawdown of 52.9%. Market peaked out here and then it started falling, and the market structure was lower highs and lower lows kind of formation. We exited these stocks presuming that market had broken 20% level, which was 1024 level at minus 20%, which happened in May 1992. And then we allowed market to fall because we never knew what will be the extent of drawdown. And ultimately, the drawdown happened at 53.2%. So we could save ourselves from a major drawdown which happened in 1992. Now the question here is, whenever the market trend reverses, we do not know this is the bottom. See, the market made a very solid impulsive day and then corrected, did not break the prior low. So this was the time we could say that the first signal market has given was that it made a higher lows. And then at this point of time, we could have drawn this trend line, set an alert on the price chart that if this trend line is broken out on upside, what will happen? This will be a breakout of a inverse head and shoulder, left shoulder, right shoulder, and breakout. And that is the time when we reposition ourselves, make a re-entry in the stock market, which was the level at 707 in July 93. What has happened in this process? We could enter at a very good valuation, 30% lower than what price we had exited. At the same time, we could avoid multiple stresses which we would have undergone during May 92 to July 93, pretty long time. And we can position ourselves. We sat on the cash during this time, nearly little more than 1 year, and then made a position, and we could took the distinct advantage of major upside move. Now let us go to check the next bear market of year 2000, which is also known as a dot-com bubble or tech bubble. In the year 2000, which was a tech bubble or dot-com bubble, market peaked at 1,818.15 in February 2000, which was here. And then massive downtrending move started, and this bear market lasted for 18 months, very long time. And finally, drawdown was 53.25%, and market made a low of 849.95 in September 2001. Now, the 20% threshold was 1454, where we could have exited as per what we are discussing today. Should we exit in the bear market or remain invested in the bear market? So what happens in April 2000, we exited the market when it was at 1454. Then we could save from a very, very major drawdown in the market, and that too for a very long time. Now what happened then? Once the market trend reverses, you can see the fall in the market. I'm looking now at a little lower time frame to understand what market made a low here, and then it stopped making lower lows kind of formation. But when it made a low of 849.95, nobody on planet Earth can say that this is the bottom of the market. We need to have some kind of reversal chart pattern. So when market did a pullback, so this was considered as a pullback, that market may further make lower lows kind of a structure. But when this correction took place, on this correction, market did not make lower low. Instead, market went up and one cycle of higher highs was completed. And that is the time, when market was consolidating here, was not making a lower low, we could have observed left shoulder, head formation, and a rising trend line, which is nothing but the neckline of upcoming inverse head and shoulder. And there was a breakout of this inverse head and shoulder with a rising trend line. So it is a little more powerful breakout, so to say. And so here was the chance to re-enter the market at 943 level. So we exited the market at 1454 and then re-entered at 943. What has happened in this period? We not only were stress-free when we exited the market, but could enter the market at a much, much attractive valuation in the market, and we were sitting on the cash. So once again, we could position ourselves in the market, time the market based on technical analysis, as we have discussed. Let us go to the next bear market and check it out. Now we are discussing the very dreaded bear market that started in January 2008 and known as a financial crisis. Was associated with the financial crisis. And there was a drawdown of to an extent of 64.56%. Friends, I know many people who were into the stock market prior to 2008. They were investors with a sizable money and they lost hope, presuming at a certain point of time when this looked like was a repetition of maybe 1929, mother of all bear markets, where the erosion of the money was over 85%. Now, coming back to this bear market, you can see the threshold limit was 20% below from the peak was 5,085, where we supposedly exit the market. And because we never knew what could be the extent of drawdown. And in March 2008, we exited the market and then waited for the market to fall. Finally, market made a low of 2,252.75 in October 2008. So friends, what happened next? Then we kept on watching the market after we exited the market, that the market started making almost vertical fall with a minor pullback in between, and ultimately it made a low here with a massive bullish pin bar formation. But was this bullish pin bar was enough to say that the trend is over? Absolutely not, friend. So we waited. This correction took place where market did not make a new low. That created a kind of hope. And this hope was enough to position ourselves into the market, where here it has made a double bottom kind of formation, again fell down, the apex was here, it fell down, again made a triple bottom, and finally the multiple bottoms apex was broken out here, and we could re-enter into the market when Nifty 50 was at 3,304 in April 2009. So we were sitting in cash. So we could enter again at a right valuation, seeing the reversal chart pattern, that is a triple bottom formation, and finally then massive bull run started in the market. So yes, nobody can enter at the lowest point of the market, but we could save from 5,085 to 3,304. So we could again successfully time the market with respect by adopting the principle of technical analysis by finding a reversal chart. Now let us go to the next bear market. Now we are talking about the bear market that started in March 2015, and market peaked at 9,119.2 in March 2015, and there was a massive downtrending move, and complete drawdown was recorded was 25.15%, and it took 11 months. Now 20% threshold limit was 7,295, where we exited the market in January 2019, and in February 2016 there was the end of the bear market. So what has happened this time? This time what has happened, the market was making lower highs and lower lows, and finally it made a double bottom here, and the apex of the double bottom was here, where we could have positioned to re-enter the market if this double bottom gives a breakout. But unfortunately what happened at this time, where the market gave a breakout with a breakaway gap. This was the candle with the breakaway gap. So yes, okay, we could have positioned, we could have entered above this high of this candle, but ultimately we failed simply because there was another gap. So finally we could enter at 7,476 in March 2016, and this time it was higher than where we exited at 7,295. So this time we could not time the market perfectly, little at higher cost we entered. Let us go to the next bear market of 2020. Now we are referring to the fifth bear market, which is a quite recent one in 2020 that began in January 2020. Market peaked at 12,430 level in January 2020. And the threshold limit of 20% was 9,944, there we exited. And finally, market made a low of 7,500 511.1, which was a drawdown of 39.6%. And market made a low and found its bottom in March 2020. What happened next? So friends, what we can see, market had a vertical fall, made a low here, and then finally we could see one bullish candlestick pattern and massive bullish candlestick pattern. But this was not enough to say that the trend is reversing. So what was the opportunity here? We draw this line, which was left shoulder, head, and a right shoulder, and finally it was broken out here, and then finally we could have entered here at this dotted line, but we refrained ourselves to enter at this point of time because the cyclic phenomenon of the market, based on Charles Dow doctrines, market did not make higher highs kind of formation. So we waited. And finally, you can say when market made this high, then corrected to find here, and then finally we could, enter at 9,335 in May 2020. So this time also we could exit at 9,944, re-enter the market at 9,335. So at a better valuation, and we could again successfully time the market. So what is the conclusion finally, friends? We discussed 5 bear markets, out of which we could successfully time the market based on the reversal chart pattern, based on technical analysis and price action in 4 occasions. We failed once in 2015. Now I leave it to the wisdom of you people to decide whether we should remain invested in the market or we should exit the market the moment bear market starts. Friends, if you like this video presentation, give a lot of thumbs up to this video. Subscribe this channel, enable the notification bell so that you remain updated all the time. Thank you very much for watching. Looking forward to meet you very, very soon.